Hello friends, in this lecture let's look into what is the difference between credit spread and debit spreads. So credit spread and debit spread are different in several ways. So first is when you open a debit spread trade, whether it's a call debit or put debit, you pay a premium, right? Something you have to pay to open the position. Whereas in case of credit spread, you receive premium. Second thing is debit spread generally used for a strong directional bias, means you prefer to do a debit spread trade when you think that stock will either go up or down. So if you think it will go up, you will buy call side, and if you think stock will go down, you can buy put side of a spread, right? Whereas credit verticals are generally used for mild directional bias, not strong directional bias. Next thing is that in case of debit verticals, you bet on where the stock will go, right? You focus here where the stock will go next. Whereas in case of credit, you will bet on where stock will not go. And we'll see what's the difference. And next point is, in case of debit spread, you have less control on your trade. And in case of credit spread, you have more control on the trade. Let's try to understand this with the help of example. Let's say a particular stock of XYZ is trading at $100 per stock right now, right? What can happen to this stock, right? It can go down, it can go up, or it can remain pretty much at the same price. When I say same price, I don't mean that it will be in the 100 itself. I mean not any big move, right? So let's try to look from a stock buying perspective. When you will make money? You will only make money if stock goes up, right? Let's say stock goes to 105, you will make $5 per stock. You will not make money if stock remains pretty much here at 100, or you will not make money or you lose money if stock goes to, let's say, 95, right? From probability perspective, let's say there are three probabilities. One is 95, stock will go to 95. One is stock will remain at 100, and one is stock will go to the 105. And let's say all the options have 33% chances, equal chances of everything, right? So if you are directional, right, if you are buying stock, you will only make money in this case. So your chances of making money is 33%. But if you are betting that stock will remain above 95, you're not saying whether it will go to 100 or 105 or 96 or 97. You're not sure about that. All you are betting on that it will remain above 95. So in this case, you have more chances of making money, right? Or put it that way, if you are saying, if a stock is currently trading at 100 and you are saying that stock will not fall too much, right? It will remain above, let's say, 100, either 100 or more than 100, right? Let's say you're betting that. So then also you will make money in this case, because if it remains at 100, and you'll make money in this case, right? So your chances are 66%. So what I'm trying to say is that it is much easier to say where stock will not go than saying where stock will go, right? In this case, you have 33% chances, and in this case, you have 66% chances, right? So that way, credit spreads are probability perspective more profitable in general, right? So until unless you are directionally biased and that works in your favor, then you can make a lot of money in this case, in case of debits. But generally that doesn't happen, right? And from probability standpoint, credit spreads have higher probability than debit. So it's your personal choice what you want to do. But if you ask any savvy trader, people generally prefer to go for credit spreads. And another reason is that in case of debit spread, you have less control on the trade, whereas in case of credit, you have more control. And what I mean by that? So let's say you open a trade and trade goes against you. Let's say you said that stock will remain above 100 and that doesn't happen, stock goes down, right? So when you are in debit trade, you don't have much control because you already paid some premium to open this trade. So if you want to roll it or if you want to adjust the trade, which we'll look into the next sections, what a roll mean and how to do that. But just to give you an idea that if you want to roll your trade or adjust your trade, you have to pay more money, right? You already paid premium. In order to adjust the trade, you have to pay more. So your cost bases are increased. Whereas in case of credit spread, you received a premium, right? And in most cases, when you roll the trade, you receive more premium. So your cost basis is reduced. So here your cost is getting increased if you roll. Here your cost is getting reduced when you roll. So there are certain ways, right? So there are different reasons why credit spread generally works better than debit spreads in longer term. So in next few sections, we'll cover both. We'll cover debit as well and we'll credit as well. But in the credit, we'll pay more attention and we'll look into much more detail for the credit spreads. So I'll catch you in the next lecture. Thank you very much.